Mr. Rubini, you spoke about coalition politics and the state elections coming up. The second half of the calendar year, do you think that could spell good news or perhaps renewed confidence in India if indeed we see favorable results coming in from the state elections and then a renewed push in reforms in the following budget?
I would say that economic acceleration is going to be conditional on a reacceleration of a series of important reforms having to do with dealing with the fiscal problem, dealing with opening up the economy to trade and financial flows, greater openness to foreign direct investment, privatization, flexibilizing the labor market, maybe introducing a national VAT, and a number of other things. The acceleration of this reform might be conditional on what's going to be the outcome of some of these important state elections. We'll have to wait and see whether the drive to reform is going to accelerate once part of that political cycle is behind.
What would be your outlook then on emerging markets? Because you spoke about the rupee, and there's been a significant fall there, and since there is that linkage with driving fund flows, what is your sense of how EM currencies would do?
Well, the outlook for emerging market currency depends very much on the country. I don't think you can generalize. I would say that some countries like China and other emerging markets that tend to have current account surpluses, and whose currency overall may be on an appreciation trend. And there are other countries like India, but also countries like Turkey, like Brazil, and a few other ones that are actually running current account deficits. And therefore, these countries running current account deficits may face further depreciation pressures unless there are enough capital inflows to finance these large current account deficits without downside risk to the currency. And those capital inflows depend on many factors. They depend on the degree of risk sentiment and risk aversion of international investors. They depend on the state of monetary policy within these individual countries, and also depend on what are the fiscal conditions. So everything else equal, if a country runs a large current account deficit that is in part driven by large fiscal deficit, if this country has an easing of monetary policy, and if global risk aversion is going to stay high because of global tail risk, there could be further downside pressures to that currency.
Right, Mr. Rubini, for the next 12 to 18 months then, which asset class would you be most bullish on? Where do you see opportunity? Would it be EM equities, DM equities, or even commodities for that matter? Where will you foresee a favorable return?
Well, my global economic outlook is one in which, while there will be economic growth, there are significant downside risks that imply risk of a recession in the Eurozone, even UK, slow economic growth in other advanced economies like the US, and also slower economic growth compared to last year in most emerging markets. So in that climate, there's economic of vulnerability with also financial tail risk. I think that investors are going to remain risk averse, and therefore, like last year, global equities might move sideways without any clear trend. When risk is on, they might go higher, but when risk is going to be off, as likely they're going to move downwards, and therefore I don't see a significant outperformance of global equities in this environment. In this environment also, commodities might also move sideways because while emerging markets are growing still robustly, economic growth in most advanced economies is going to be weak, and therefore the two things are going to be a wash. Of course, commodity prices could go higher, especially for oil and energy, if geopolitical risk in the Middle East, like potential confrontation between Israel, US, and Iran, could lead to a risk premium in oil prices. So, in my view, we're still in a world in which there are many tail risks, and therefore it's better to be safe rather than sorry. An investor will be better off by investing into the safe bonds of government and countries that don't have significant fiscal vulnerabilities, or in companies that have very strong balance sheet in terms of having low debt and leverage, having high dividends. So, companies that are multinational corporations, both in advanced economies and emerging markets, with sound balance sheets and sound P&Ls, probably might outperform, but we live in a world in which there will be lots of tail risk, and therefore being defensive in terms of global asset allocation and being less exposed to a variety of risky assets, whether it's commodities or equities, and being more exposed to things that are more liquid and more safe might be a strategy that minimizes some of the downside risks.
So Mr. Rubini, before we wrap up this discussion, just give us a broad perspective. Based on the scenario that you're painting out for the world, what would happen? Would we do better, or could there be a catastrophe in the market 6 to 8 months down the line? And if so, what's the way out then?
Well, I would say you have to assign probability to something disorderly happening in the Eurozone, and you have to assign some probability to disorderly defaults and even a breakup of the Eurozone, not in the next 6 to 8 months, but certainly over the horizon of the next 2 or 3 years. And if, and I'm just saying if, that breakup of the Eurozone were to occur, the systemic effects of it could be much bigger than the disorderly default of Lehman Brothers in the fall of 2008, because after all, Lehman Brothers was a $600 billion problem, while the debt, the public debt of Italy and Spain alone are at 3 trillion euros, or about $4 trillion dollars, and therefore if there was a disorderly default by Italy and or Spain, that will be a shock that will be systemically more important than even the disorderly collapse of Lehman Brothers. So I'm not predicting that to happen in the next 6 to 8 months, but I would say that you have a set of countries in the Eurozone, Greece, Ireland, Portugal, Italy and Spain, that each one of them with different probability could have a coercive restructuring of their private and public debt, and each one of them with different probability could eventually exit the Eurozone. If the combined of these events were to occur, the systemic effects on the global economy would be absolutely as severe, or actually more severe, than what happened in 2008. I'm not saying that it's going to happen with probability 1, but you have to consider this is an important tail risk that has a meaningful probability that would have a systemic effect on the global economy over the next few years.
We live in uncertain times. Mr. Rubini, thanks very much for joining us and giving us your outlook for 2012.
A pleasure being with you today. Thank you.
Well, thanks so much for watching this special edition of Crystal Gazing. Stay tuned to ET Now for more news and updates.